What's going on, everybody? Today, I'm going to give you the explanation of Bitcoin, a non-technical explanation. First, we're going to cover a little bit of what money is and the history of money, how that money evolved over time, and then we'll talk about Bitcoin, hopefully not diving too much into the technical details, so that you can make a better determination on whether or not you want to include this in your investing portfolio. Money first started to really solve this idea of the double coincidence of wants. So I was a farmer and I had a goat. You had some chickens with some eggs. I wanted 12 eggs, but I didn't want to give you my whole goat. I couldn't cut up my goat. I couldn't give you certain parts of the goat. So we had to have some sort of medium of exchange to solve the two goods that we were trying to exchange. This is where money comes in. Money has 6 core principles that I want you to keep in mind as we discuss things throughout this video. It's relatively scarce, so you can't find it in abundance in nature. It's divisible, so you can break it up into smaller units if you want to transact for different goods or services. It's immutable, so once it's created, you can't change it and it's not susceptible to change. It's a medium of exchange. Going back to the double coincidence of wants, it serves as that medium between the exchange of goods and services. It has a recognizable value. The people that are transacting in it need to both recognize what the value of that money is. And it's portable. It needs to be able to be moved because you're using it as a medium of exchange for different goods and services. So keep those 6 core factors in mind as we discuss money throughout this video. One of my favorite stories is the one of the rye stones. The Yapese people had these rare stones that they called rye stones, some being as big as a house, so you really couldn't move them. And in fact, the way that they would transfer ownership of these rye stones is they would have this huge town meeting and then declare the transfer of ownership from one person to the next. These rye stones could be used to buy things like houses or ships, and over time, they used this as their medium of exchange and their source of money, until obviously the European settlers came and ruined it by bringing a bunch of these other stones in. Fast forward a bit, and a lot of different empires used gold because it was relatively scarce, it was quite portable, you could move it around, and everybody knew that it had a sense of value. As that evolved, it went into coins. A lot of these coins were stamped, whether it was by a government entity or by some god or deity to basically bless the coin so that everybody knew that it had a value. As this evolved, people realized coins are quite cumbersome, especially with the metal ones. They could get heavy over time, or some thieves along some sort of trading route would steal them. So the Chinese in the 7th century were the first to ever come up with the idea of paper money. Now, this paper money was essentially a deposit, in a sense an IOU, that people could use to transact the physical coins, but it essentially had a receipt. This evolved into paper money. And really with paper money, at first, it was backed by something like gold. Now that was important because you can essentially exchange whatever paper note that was for that same value in gold. A lot of these paper notes are backed by banks. In the Civil War, we had tens if not hundreds of different banks. And then in 1931, FDR decoupled the US dollar from gold. He did this because at the time we had an economic depression, so they had to use fiscal and monetary policy tools in order to help the economy at the time. Britain did it just a couple years earlier, so he was really kind of following suit. Now, after the war, all the winning empires got together. They're all licking their wounds trying to figure out where are we going to go with money in the future. Well, during this, the Bretton Woods Agreement basically said that the US dollar was now to be the world standard for currency because the United States had 2/3 of all the world's gold after the war. Over time, people used this as a sense of value for commodities. They used it for exchanging between different countries, even if they weren't involved in the United States. However, in 1971, Nixon declared quite another feat again. He decoupled the US dollar from gold. What that meant is we evolved into what we now know as fiat money. Fiat money being money that is backed by some sort of government, but it really is not tied to any sort of value with a precious metal like gold or silver. And even today, US dollars are not backed by anything. It's only worth what we think it's worth, and that really is determined by the Federal Reserve, which is a public-private entity partnership. So if you think back to what we were talking about earlier about the Yapese stones, about gold, about the coins, it follows a lot of those 6 key core concepts, right? First, with the rye stones, they were relatively scarce. There was only a certain amount on the island, and obviously when it was flooded with the immigrants, it lost its value. Hence why we're not using rye stones to this day. It acted as a medium of exchange. People could exchange goods and services for these rye stones. It had immutability because it was not susceptible to change once it did in fact become a rye stone. It definitely had a recognizable value because the people of Yap all saw rye stones as having value, but it wasn't that portable. So it really failed in the divisibility of it and the portability of it. Now, if we go to coins, Fits a lot of those key tenets as well. However, it was more portable, not the most portable, and it was kind of divisible if you had different coins, or in some cases, people were breaking off portions of coins. Now you get to dollars, and it solved a little bit more of that. It was a little more portable, a little more scarce, had a recognizable value, it was immutable, as in you can't change the notes once they're made. It had a lot of those core properties. But now let's think of Bitcoin. Now, what's interesting about Bitcoin is it wasn't the first sort of digital cash system or even attempt at a blockchain. In fact, there was BitGold, there was DigiCash, there was a variety of other examples, but they all failed to really garner the support that Bitcoin did. What's interesting is Bitcoin, the white paper at least, from Satoshi Nakamoto, which is a pseudonym. No one really knows if it's a he, her, it, them, a group, who knows at this point. But that white paper was released on October 31st, 2008. The historical significance behind that is it marked really the end of one of the worst recessions the United States has seen in decades. Bitcoin was written by Satoshi Nakamoto, whoever that him, her, it, or group is, and it was written with a no admin access with C++ code. That means that nobody can change it now. Nobody can change the fundamental code of Bitcoin. That's the beauty behind it. Nobody has control over it. The only people that do truly have control of it is the decentralized network of computers known as miners. Bitcoin has really evolved in this crypto movement, and it's now become, in a sense, digital gold. People are adding it to their portfolios as an alternative asset, but also because they think that it has inherent value like gold has value. The security of Bitcoin is directly proportional to the amount of participants in the network. The more miners that are added to this network, the more secure it is, because in order to get a 51% hack, it will require an enormous amount of computing power. In fact, today, the last estimate I saw is it would take $13 billion worth of GPUs and computers in order to get a 51% hack on the system. Oh, by the way, you can't even buy $13 billion of ASIC miners at this point with the amount of chip shortage we have going on. It's practically infeasible. And in fact, it's actually economically better for you to be an honest participant in the system than it is to try to hack it. These miners are trying to solve the cryptographic hash. Think of it like a random string of characters in which if you have the right answer, it's easy to verify, but you can't back calculate how to get there, which is in a sense the encryption. So once somebody finds whatever that cryptographic hash is or that nonce, it's easily propagated throughout the network and all the miners can verify it. Another way to think about Bitcoin is it's essentially a digital ledger that's maintained across a network of computers called miners. And in this ledger, it is keeping track of all the different transactions that have happened over the last 10 to 20 minutes. The transactions are from public address to public address. Think of it kind of like your own public address for your house. You could know the address of a house, but you don't necessarily know who lives there unless you get something like a yellow book, and there is no crypto yellow book. You need a combination of that public and private key in order to access the wallets that are used for the transaction on the network. These ledgers are maintained throughout the network of computers, and they're secured by the network of computers as well. Bitcoin was not the first digital cash. It was not the first attempt at a blockchain technology. But what it did is it roped together all these different key core concepts that really made it fundamentally novel. The two main things being, one, it solved the double spend problem, which is that A gives Bitcoin to B at the exact same time that he gives to C, and ensuring that you cannot what's called double spend. So if you have one Bitcoin, you can't send it simultaneously to two different people, thereby creating an extra one. And the second thing was something called the Nakamoto consensus. Now what this was a computational economic incentive model that essentially made it more costly to be a malign actor of this system than it is to be an honest participant. It is more economically beneficial to be a part of the system, be a miner of the system, than it is to try to hack it. And that's a really core thing that makes it even more secure as this network grows. Think of it like an open, decentralized database in which it's a ledger of all the transactions that have ever happened over the network. It has a native currency, and that's what's called Bitcoin, but the transactions are stored on what's called blocks that are added every 10 to 20 minutes. So these miners all come together and they verify all the transactions for the last 10 to 20 minutes. They also do what's called mining, which is solving a cryptographic hash in hopes of a reward that will incentivize them to be a part of the system. So if you think of a miner, you often see these big towers with GPUs and server racks. Well, what they're doing is they're essentially using 50% of their computing power to verify all the transactions that have happened within the last set period. Those then transactions are consolidated, verified across a network of computers that are decentralized, and then added to the next block of that blockchain. The other 50% of their computing power is going and competing for that mining reward. Now, what it's doing is it's trying to solve a cryptographic hash, which is computationally expensive. And the more people that are trying to solve this puzzle, the harder it is to solve for each individual, which is oftentimes why you see all these different ASIC miners and GPUs that are all racing to get better what's called hash rate, or terahash per second, whatever the unit of measure will be in the future. And they're all competing for that block reward. Now, right now, that block reward sits at about 6.25 Bitcoin for every block that's added every 10 to 20 minutes. And it even started as high as 50 Bitcoin. That model halves every 4 years. So in May of 2020, it halved. In May of 2024, it'll halve again to 3.125. And then whatever half of that is in May of 2028, all the way until 2140, when the last Bitcoin will be mined in existence at 21 million units. Right now, we're sitting in about a circulation of about 18.5 million Bitcoin. We're only ever going to have 21 million in existence. Relative scarcity. There's only 18.5 million in circulation today. Only 21 million will ever exist. Divisibility. You can divide a Bitcoin down to the millionth, called a Satoshi, so they could use different units in order to transact for value. It's a medium of exchange. People are currently using it for dollars. They're using it for pizzas, as they did a long time ago, for coffee, and some people are even buying houses with it as well. It's immutable. You cannot change Bitcoin once it's minted, created, and added to that transaction ledger. It has a recognizable value, which is why you can trade dollars for Bitcoin. It's also portable. It transacts at the speed of light, and it's stored on a wallet, whether that be on an exchange or a personal wallet. The biggest downside to crypto, though, if I'm going to be honest, is just the volatility of it itself. There's an insane amount of leverage in the market right now. A large supply is really controlled by whales, people that own a large majority of different cryptocurrencies. And right now, it's kind of like the Wild West. I know a lot of Bitcoin or crypto maximalists will hate me for saying this, but we need regulation. We need proper and adequate regulation from government so that it doesn't crush the entire industry, but we also need enough to at least protect investors and to make people more comfortable to be a participant of this system. In fact, the more protections that there are for investors, the more things like stablecoins are regulated to avoid Terra Luna collapses like we saw and potential other stablecoin depeggings. The biggest threat to Bitcoin right now is government regulation. I know people say Bitcoin is dead, winter's coming. Really, the looming threat is, what is the government going to do when they regulate this? A lot of people think it can't happen, but Bitcoin is a relatively small market cap compared to most things. In fact, the entire cryptocurrency industry is sitting at right around 900 billion to around $1 trillion at this current date. If you look at gold, that's 7 trillion. It's 7x what currently cryptocurrency is worth to this day. Corporate debt, government debt, 200 trillion. And now if we add in derivatives, we're in 1 to 2 quadrillion, which is thousands of trillions. Actually, we don't even know how much derivatives are really worth. That's that murky. So if you look at scale, compared to different asset classes, it is so small in comparison. So the government regulation could actually still choke the industry out. However, I'm optimistic. I think Gary Gensler at the SEC has been doing an amazing job, and I think that he will hopefully bring in regulation that's good for the industry as a whole. And if this Bitcoin seems like something you want to add to your portfolio, first off, I am not a financial advisor. This is not financial advice. Please consider talking to your financial advisor if you'd like to do so. However, if I were to make a recommendation for myself, I would allocate about 1 to 5% of your portfolio into cryptocurrencies or alternative currencies. That way, if this becomes what it's intended to be, you won't be left behind. However, if it goes to zero, which there's a probability of that too, it won't make any impact on your portfolio for the future. I still think there's enormous potential with Bitcoin. If you look at Bitcoin becoming the digital gold, so maybe assuming a market cap of 7 trillion like gold is today, that's about a $350,000 to $400,000 Bitcoin. However, I personally think it's going to be more than that. Right now, it is absolutely gut-wrenching to look at the price. Don't invest money that you can't afford to lose, and be patient, because there's a monumental shift coming in the financial industry, and blockchain will be the core backbone of that monumental change. If you like this video, please give me a like and a comment below, and give me feedback. I'm new to the content creation channel, so I'd like to tailor these videos to better suit your needs. Thanks, and I'll see you around.